Continuing our discussion on financial decision making, let's look at some more quantification, at least a little bit. Let's look at some numbers. If you're valuing a security with a law of one price, right? What value can you attribute to an object, to an asset? If somebody says, look, I promise you to give you a risk-free payment of $1,000 in 1 year. If the risk-free interest rate is 5%, what can you conclude about this price in a market that's a normal market? Remember, in a normal market, there cannot be a arbitrage opportunity. So if we want to find the present value of $1,000 at the risk-free rate of 5%, this asset would be worth $952.38 today. That would be the price. What would happen if you could buy this asset for $900? Well, of course, you and everybody else in the market would see that it has a price lower than what it should be, and everybody would want to buy this asset, and the process of everybody buying would drive the price right back to the $952.38. So in this marketplace with no arbitrage, again, the prices have to remain the same. So in this case, again, if you could buy the bond at $940, there's $12.38 would be the arbitrage opportunity. Again, in a normal market, that cannot exist. You cannot find two identical assets that have different prices in the same market or even in similar markets in a market model. So unless the price of a security equals the present value of its cash flows, an arbitrage opportunity can exist. So in other words, what this is saying is, for the law of one price to exist, the future cash flows, if you find their present value, they have to be equal to the current price. So the price of the security has to be equal to the present value of all the cash flows paid by the security. So as we go through this course, we're going to be talking about something referred to as valuation. How do you find the value of an asset, right? How do you find the right-hand side of this equation? We need to identify all the cash flows that can happen in the future. That's difficult enough with the prediction that's necessary, but what adds to the complication is we also have to figure out what return do we want to receive for this, right? What is the cost of replicating those cash flows, right? So what is it going to cost for me to buy those cash flows in the future? So we're going to have to utilize some techniques, some quantitative and statistical techniques in order to determine the value of these projects as we move forward. So let's talk a little bit about interest rates for a second. If we know the price of an asset, and it's a risk-free bond, we also can solve for the risk-free interest rate because, again, there can be no arbitrage opportunity. So essentially what we're saying now is we know what this asset costs. We can buy this asset today for $929.80. In the time value model, again, remember all cash outflows have to be designated as a negative number. So we have $929.80. The future value is $1,000. And again, if we assume this is a risk-free bond, what we're saying is that the risk-free interest rate must be 7.55%. We can actually even use this in some more current types of terms. What you can identify from buying bonds is you can buy a government bond that says that the price is 98% of the par value. If the par value is $1,000, then you can buy a government bond for $980 that matures at $1,000. If you know how many years that will take, solving for the risk for the interest rate will give you the risk-free rate for that particular government bond. So let's think about what this means with respect to values and making decisions. In a normal market, the net present value of buying or selling a security is zero. So the net present value of buying a security is the present value of all the cash flows minus the price of the security. And the net present value of selling that security is the price of the security minus the present value of all the cash flows paid. Those things net to zero. So trading securities in a normal market neither destroys or builds value. So let's kind of think about that. When companies are issuing and selling stocks, the process of issuing stocks to the public does not create value. So where is value created? Value is created from the investment of those cash flows by the company, right? Both sides believe they're getting a deal. One of them is going to get a positive amount of gain, and the other is going to get the exact magnitude but a negative sign. So the net present value, if you will, of buying and selling securities ultimately is zero. Value comes from investing money in assets, not how we get the money, which is the process of issuing securities. So the separation principle says we can evaluate net present value separately from the decision of the company in how to finance that asset. Since issuing securities in itself does not create value, the value ultimately is just created by the actual purchase of the investment itself. The law of one price also has some implications as far as packages of securities. Assume we have two securities, A and B. Suppose there is another third security, C, that has the exact same cash flows as A and B combined. Since these are identical assets, since asset C and its cash flows are identical to the cash flows of the combined assets A and B, they have to have the same price. So one question we might ask is, how can, if asset C is actually asset A and B, how can I make asset C, how can I create more value? How can I increase the price of C? Well, there are only three ways to do this. You need to find a way to make asset A more valuable, or find a way to make asset B more valuable. The only other way to increase the price of C is to add another asset, right? So value additivity implies once you buy an asset, the only way you can grow, right? There's only two ways you can grow. Take whatever you have and make it worth more, or buy something new, buy something different. So we have a company, it's called Moon Holdings. It's a publicly traded company. 50% of it is Dew Beverage, 70% is Mountain Industries, and 100% of the company is Oxford Bears. So the total market value of this Moon Holdings is $200 million. Dew Beverage is $75 million, and the total value of Mountain Industries is $100 million. The question is, what is the value of the Oxford Bears, which in this case is a non-traded private entity within this publicly traded company? So you think about 50% of Dew Beverage. Well, if Dew Beverage is worth $75 million and I own half of it, that means I own $37.5 million in value. 70% of Mountain at $100 million is $70 million. So what is the value of the entire company? So the entire company, Moon, is $200 million. Now, if you subtract the $37.5 million in Dew Beverage, and then you subtract the $70 million in Mountain Industries, what you're left with is the value of Oxford Bears. In this case, it's worth $92.5 million. And again, under this value additivity concept, the sum of the value of all the things within the company equals the value of the entire company. To maximize the value of the entire firm, then, we need to make decisions that maximize net present value. So the net present value of a decision represents the contribution to the overall value of the company. So just kind of referring back, if you do projects that have positive net present value, you are adding to the overall value of the firm. If the firm is growing, who gets the benefit of that growth? And of course, it's the shareholders. So let's think about where we're going to go in the rest of this course. We need to talk about and discuss the impact of risk on valuation. When cash flows are risky, we have to discount them at a rate that's an appropriate rate, right? We can't, if something is risky, you can't use the risk-free return as your benchmark for value. We have to have an appropriate number. So we need to determine something referred to as a risk premium. What extra should you get paid for taking risk? The challenge of this is we have something referred to as risk aversion. Investors prefer a safe income rather than a risky one. So how does our perception of risk impact the value of the assets we purchase? And the answer is simple, but it's very complicated. Everybody is different. Everybody has a different sensitivity, if you will, to risk aversion. Two people given the exact same set of data can come to two conclusions as to the magnitude and the direction of the changes in that asset. So in the end, we have to come up with a number, if you will, to calculate what is the risk premium. Again, it's the additional return that you expect to get for buying a security's risk. How does the market determine the price of an asset? What's the difference between the value that the market places and what the risk-free rate of return is? Right? How does the market price the riskiness of individual assets? If an investment has more variable returns, if there's more volatility inside the prediction model of predicting future cash flows, then investors are going to want to receive a higher risk premium. People need to be paid for taking risks. So the risk of a security must be evaluated in relation to the fluctuations of other investments. Again, this is alluding to the concept of opportunity costs. Two opportunity costs that are the same have to have the exact same risk. They have the exact same returns. So a securities risk premium is going to be higher the more its returns tend to vary within the economy and relative to maybe a market index. If the securities returns vary in opposite direction of the market or the economy, then we actually can look at these as having a negative risk premium, which may provide us in certain circumstances. It could provide us with insurance mechanisms where we can insure against some losses. So again, this is the end of chapter 3, and we have a ways to go with the rest of this course.